the key piece here is that broader access, multiple products, multiple assets that you have the ability to be able to hold and trade and use for whatever forward mobility looks like.
Hello and welcome back to the Fortune Crypto Playbook. I'm finance and crypto editor Jeff John Roberts.
And I'm senior reporter Leo Schwartz.
Leo, a big moment this week. We mined 20 million Bitcoins. Did you sort of pause and have a moment or, toast at your dinner table?
I don't know if we had a celebration here. I don't know how you would celebrate something like that, but it does seem like a momentous occasion. But the hard part for Bitcoin is there's very few left to mine, right?
Well, 1 million, but fortunately there's more than a century to do it. So get them while you can, I guess.
I guess the difficulty is it's incredibly expensive now to mine a Bitcoin, and the price of Bitcoin is pretty variable. So as always, I think there's questions as to what the economics look like moving forward and whether all these Bitcoin miners are going to flee for AI. So it'll be interesting to see what happens in this next era of 1 million Bitcoins left to mine.
Yeah, I think that's a question for another episode, but I do think it's interesting because next halving is in 3 years or so? And that means you're going to get the reward block is going to be, I guess, what is it now? It's 3 and a bit. So it'll be 1.5 Bitcoins, and then it's going to be under 1. So, I think the theory is transaction revenue is going to make up for that at some point. But, perhaps let's get a miner on the show, unless you have any strong thoughts right now, Leo.
Yeah, if the miners leave for AI, I think for crypto, the existential question is, can they find some way to make crypto relevant for AI? We've seen a lot of bad pitches over the past few years with the huge hype cycle around AI, but maybe the most convincing one is this idea that if agentic payments rise, so basically if the internet is just crawling with billions of agents that you deploy to do your shopping for you or to do your trading for you, they're not going to be using fiat currency for myriad reasons. Instead, they'll be using crypto to do it. And this is basically the thesis that a lot of companies are staking their futures on, including Circle, which issues USDC, as well as Stripe, the payments giant, which is increasingly putting a wager on the future of payments being in stablecoins. Jeff, I know that you wrote about this in your newsletter this week.
Yeah, I think this is fascinating. I thought that was a very good Bloomberg piece that took a very kind of down the middle look at it. And the point being, stablecoins, the proposition has always been cross-border remittances, cheaper payments. However, they're trying to make the case for nano payments or domestic payments just done natively on the internet, which I think is a good idea. And I think the thesis put forward is basically there's going to be all these microtransactions, for instance, like data calls. And if the world works out like I hope it does, the big LLMs, the Anthropics, who's already done a settlement with Reuters news agencies, and others are going to be forever querying for data. They're going to need to pay for that data. How do you pay cents or pennies or less each time? Totally impractical with Visa or MasterCard rails. But if you've got native stablecoin payments, over the internet, the economics of it work for microtransactions, big batches of them all the time. That could be wishful thinking, of course. And the article points out the amount of, agentic commerce is 25 million or something compared to 6 trillion. I think that number actually 25 million was just on Base's 402 layer, which I think is super interesting. But they put in my article, this has got to start somewhere. And I don't think it's silly to think that in the AI economy, there's going to be, huge needs for microtransactions. As for how agents are going to work, I don't know. It's one of these things that's hard to see. I think Circle and Stripe and Coinbase are saying it's going to be more like B2B at first rather than individual payments. But I don't know. You're pretty immersed in AI, Leo. Where do you see this going?
Yeah, I think it's fair to say that we're about to see a complete revolution as to how internet commerce happens. Just like 20 years ago, you saw a shift from money being traded more commonly in person or at stores to it all happening on Amazon or other online retailers. But even if we have a future with agentic commerce, I think the bigger question is, are stablecoins really the answer? Is blockchain necessary for this? You said that it wouldn't be feasible on Visa and MasterCard rails, but maybe it would be. Maybe they'll create their own tech. Maybe it'll be private blockchains instead of public blockchains. Maybe there will be more efficiencies where they don't have to charge the fees, or other players competing on fees, meaning that Visa and MasterCard reduce the interchange fees that they're making and have to upend their business model. I feel like it would be reasonable if banks and these payment processors figured out other ways to be able to move cents in the dollar more easily and more quickly. It doesn't necessarily have to be done in stablecoins. I think the advantage that crypto folks have said for forever is that crypto is inherently programmable money. So you can program it basically to act certain ways, to trigger if certain variables are reached. But again, I don't see a reason necessarily why this can't be done on other existing rails. And we'll see if that value prop takes off. But, notably, and you wrote about this in your newsletter, a Visa and MasterCard are partnering with crypto companies, but they're also building their own rails. And I think they're basically taking a bet that we don't know what it's going to look like. It could be crypto, it could not be. But we might as well prepare for the future.
Yeah, remember when Visa and MasterCard shares fell when Stripe announced their blockchain? And however, they bounced back a bit. And as our colleague Ben Weiss wrote, there are these big partnerships between Stripe and Visa. However, I think it's a last mile and a sort of consumer play. Yeah, you need the consumer-facing stuff. You need Visa and MasterCard. But on the B2B end, if OpenAI is going to go pay for all these data calls, I think that stablecoins are a natural way to do it too, because also those tech companies too are both, I think, advanced enough to figure out how to plug it all in together. Showing my age here, but some of you have probably seen a 404 error on the internet, like page not found. There's a 402 error too, which means payment not found, because when they built the internet, there was supposed to be a native payment mechanism built into it, but they never built it. And I think that's why Coinbase called their thing 402. And it just seems to make a ton of sense. You can't really wish something into existence, but, I think if it was just Circle and Coinbase, it might be a little bit whistling in the dark, but the fact Stripe is in on this too, I think there's a there. You're not totally skeptical on this, are you, Leo?
Yeah, again, I think the bigger question is why it has to be on crypto instead of other rails. And I would be curious, and hopefully we can get someone like Zach Abrams at Bridge, or even a skeptic to come on and really explain why the existing fiat rails can't work with this. I mean, I think pretty undeniably, we are going to have a future, like you said, where there are agents doing data calls where they'll have to pay a cent or 2 cents at a time for data. But whether that's done with stable coins or whether existing rails or new rails emerge just to be done with plain old bank money remains to be seen.
Well, I mean, I think we should maybe have Visa or MasterCard on and they can explain it to us, because my understanding is people always think, credit card fees are so expensive, or, Visa's fees. The way these work is when you swipe your card and you get your rewards, the merchant pays like 3%. But a very small trickle of that goes to Visa or MasterCard. That's the bank taking most of that. And debit card fees, I think, are more like 15 cents. But for, huge volumes of microtransactions, I don't know if that's feasible. Visa is still a middleman there, whereas I think native stable coins on both sides would lower that, and also would just be easier to settle and keep track of on a blockchain. But definitely, let's put a pin in that one for a future episode. Well, turning to other news, Leo, we looked in this week on whether the next big crypto event on the calendar, Token 2049 in Dubai in April, is going to go forward. They told Carlos, a reporter, that it will. Our sympathies to everyone in the Gulf right now. That can't be fun. Realistically, it's going to be sort of curious to see what happens, because Dubai has really made a name for itself as, a must stop on the crypto circuit. And they've got, all these new legal regimes in place and things like that. I guess trying to predict this is the same as trying to predict what's going to happen, in the Gulf with this conflict. But do you have any immediate thoughts?
It wasn't too long ago that it seemed like the future of crypto would be both in the Middle East and in Asia because of the regulatory crackdown in the US. Obviously, the election of the Trump administration shifted that, and a lot of folks came back to the US. The Middle East remains a huge crypto capital, not least because of the tax advantages in places like Dubai and Abu Dhabi. But the other advantage they have, which was this fact that it was sort of stateless in a way that anybody from around the world can more easily go there, and presumably it was safer from violence, seems to be in more question now. So I think it was smart to look at this flagship conference in Token 2049 as a bellwether for whether Dubai and Abu Dhabi can really remain as crypto capitals. It seems like at this point, they're still continuing. Obviously, we're still more than a month out. And like you said, anything can happen with the war there now. But certainly that allure that they had of being this safe place for crypto builders to go is sort of rupturing. We'll be curious to see what happens.
Yeah, it might be safe legally, but if it's not safe physically, that's a different question. And I confess at first, I think a lot, I felt a little bit of the, there's some sort of glibness, like, the Lambo owners and like influencers, now they get a taste of like the real world. But, I'll sort of piece saying that, Dubai is sort of becoming, compared to the rest of the Middle East, they are building something. It's cosmopolitan, it's international. is still taking shape. And, obviously crypto is a part of that. And of course, we know people over there. So I think we're kind of hoping for the best for them. For now, they're putting on a brave face saying crypto or token 2049 is going ahead as planned at the end of April. Obviously, we will see. Anyways, wishing everyone there well and hope you're staying safe. Some news on World Liberty Financial, Leo. Did you see that one?
Yeah. So, World Liberty Financial, obviously the Trump family's crypto project, has always sort of been trouble in paradise. I think Ben and I have both been spending more than a year trying to figure out exactly what the product is that they're building. They've said a lot of different things, from having a debit card to allowing for a trading platform to basically holding this basket of assets that appreciates. But the bigger issue for the platform is that its token, which obviously has been a hot commodity for a number of reasons, maybe just because people want to hold it to ingratiate themselves to the Trump family. But it has been losing value, and now it might be losing even more value because of an onerous requirement that they're proposing about having to stake the token if you want any rights to governance. Is that right, Jeff?
Yeah. I think there's this new, proposals come down saying either stake your token for 2%. I'm talking about the unlocked ones, or else lose your voting rights. And I think people are, understandably upset because that's kind of a catch-22, because staking it, well, you have no say, you lost control of your asset for a bit, you can't collateralize it. I understand why people are upset. But, going back to what you said at the outset, I think this is a bigger question. What are these things for? Frankly, the utility of this token, every token's got a narrative, and the unspoken one here is you get access to the White House. American historian me thinks this is not a good thing, but that is the, the killer use case for WLFI. For the token, it's basically, a way to buy the government. And that's going to work as long as President Trump is in office. But what's the value or the utility going to be if he's no longer in office? And, not just that, World Liberty token, but all of his sort of satellite ones as well. It's going to be very interesting to see the value of those in the, post-Trump era.
Although when you talk about the utility of, maybe getting access to the White House, ironically, it wasn't this token that the top holders got to go to the fancy dinner at a Trump golf course and sort of meet the president. It was his meme coin. So you don't even get a dinner with World Liberty Financial.
Yeah, I'm losing track. Well, you get access to his advisors or something. All I'm telling you, Leo, is if you went in there and, bought 5 million World Liberty Financial tokens, you probably could get a pretty good meeting.
There's a couple big pieces of news over the last week, both involving Kraken, one of the larger crypto exchanges from the US, not quite as big as Coinbase, but increasingly becoming a bigger player, especially as they gear up for an apparent IPO. Kraken's two big pieces of news, one of which is they got access to a Federal Reserve master account, a limited purpose one, but still a huge milestone for a crypto company. The first time the digital assets bank has gotten this. We'll break down what that means. And they also announced a partnership with Nasdaq to explore tokenized stocks, which is obviously something that we've talked about at length on this podcast. So let's turn now to our guest, Kraken Co-CEO, Arjun Sethi. Arjun, thank you so much for joining us today. And it's a great time to have you. A lot of exciting news happening over at Kraken.
Yeah, thanks for having me.
Let's start with the first news, which is the Fed master account. Do you mind just breaking down what this means for our viewers?
First and foremost, we worked on this for a fairly long time, but the Fed master account simply just allows any institution, us in this case, to hold balances directly at the Federal Reserve. And then it lets us settle payments in US dollars. So in practical terms, it just means that payments can move directly through the core settlement infrastructure of the US financial system, rather than through multiple intermediaries that we use, what we usually call correspondent banks. For our customers, it improves efficiency across the board, and then even risk management, because settlement then happens with central bank capital.
I want to break that down, but maybe just to start, and this is for everybody who's not necessarily a financial regulation lawyer, I feel like there's been a lot of terms being thrown out the past year with the OCC charters, now people applying for these Fed accounts. Can you just talk about what this process has been for Kraken and what you set out to do? And then we can actually break down practically what the new license will allow you to do.
One, we have a SPDI charter in Wyoming. Two, we applied for a Federal Reserve master account, and there was an application for that. Third, you meet with federal regulators, Fed, OCC, et cetera. And then fourth is what we just talked about, which is what does the account allow you to be able to achieve? The easiest way to understand this is that there's two layers involved right from the beginning. One is just the banking charter. So for us at Payward and Kraken, the special purpose depository institution framework in Wyoming, The charter was created by Wyoming legislature, and it's overseen by the Division of Banking. It's designed specifically for digital asset institutions. And I think that's the most important piece, that want to be able to operate with a fully reserved banking and regulatory oversight. The second layer then on top of that is the Federal Reserve System. So in the US, banks settle and hold balances through accounts of the Federal Reserve. So getting a master account is essentially getting access to the core settlement infrastructure of that system. And then the process, as we just talked about, has taken several years. So it involves working with state regulators. Then you have to go through supervisory review. Then you apply to the Federal Reserve System, and then you demonstrate that the institution meets the operational liquidity and risk management standards required to interact with the Fed's payment infrastructure, which I think is pretty reasonable. And you want to be able to show that you have the wherewithal to be able to risk manage your customer's asset. In our case, all of our customers' assets are deposited one-to-one. It's fully reserved. We don't do any, credit or lending similar to how you would a typical bank. So when people talk about a master account, what it really means in practical terms is the ability to hold balances at the Federal Reserve and settle the transactions in US dollars.
And this is an important distinction, and thanks for bringing this up. So a lot of other crypto companies have been going through the Office of the Comptroller of the Currency first. We've seen that happen with Circle, Bridge, under Stripe, Crypto.com. So you did this a different route, going through Wyoming and getting a charter through Wyoming. The end goal is similar, which is a lot of crypto companies want this access to a Fed master account. I know this term has also been thrown out a lot recently, this skinny account that was proposed by Governor Waller. Is this a form of the skinny account?
This is a form of the skinny account. What we are focused on now is that we have the FedWire funds, the settlement, and then we have the overnight balance limit. And then over time, you think about what you can do on behalf of ACH and FedNow, and then obviously interest on the excess reserves. You want to sort of work your way up there to be able to show, here's what our customers' assets can do. Here's how we safely attribute them. Here's how we want to think about moving them, and what are the types of products and services. So in essence, yeah, it's a skinny account, but it's, a few pieces out of the 7 to 10 things that they allow you to do.
Yeah. Well, can you break this down maybe in a bit more practical terms, what this actually means to have access to these tools like the payment rails? So what are some products on Kraken that will be changed by this? How did it operate before, and how's it going to operate now that you have this access? What makes it better?
We have customers that are retail and consumer. We have customers that are professional traders worldwide. And then we have customers that are institution. The short answer is that the immediate impact is mostly at what we call our infrastructure layer. So it flows into all of these products, and then we serve multiple clients when you go further. So the biggest areas are spot trading, margin trading, derivatives, and what I call collateral management. And then we're obviously now starting to talk about tokenized equities and assets being held. These are all tokens. And so as a fully reserved bank and a qualified custodian, a lot of these assets that trade on our platform then can also function as collateral across different markets, which means that people can deposit these. And then you have improved capital efficiency for customers 24/7. The piece that I think people miss when you think about a vertically integrated exchange, across spot, margin trading, derivatives, staking, and custody, is that the infrastructure that we have changes now because of the Fed master account around how we move these assets between other products rather than sort of how we think about replacing them. What it really does is control risk management on behalf of our clients, and then our clients can also think about controlling their own risk management.
And is this a pilot? So what happens after the first year of this program?
The way to sort of think about account features is that right now we have the FedWire funds, so we're able to settle. And so that's real-time wiring. And then overnight balance limits, right? So that allows us to keep a bank account with the Fed ourselves and on behalf of our customers' deposits. The other areas are, as I mentioned before, FedNow, ACH, and then interest on the excess reserves. So the way to think about it is that we're like notching up as we can prove out, who we are as a financial institution and who we serve. Then over the course of the year, we'll move up to the next set, or maybe another year later to the next set. I think that's what's really important. I've never heard of a Fed master account being a pilot, but once you have access to the Fed master, even if it's a skinny, you start moving in and figuring out, what is it specifically that you're going to be able to offer to your clients all over the world in many cases.
So the goal is to move beyond this more skinny designation to get access to the full suite of products.
That's right.
Obviously, we've seen some inevitable pushback from banks, and the bank lobby, the Bank Policy Institute came out and said that this basically went against the window that was supposed to happen for this idea of a skinny account where there would be a window of public notice and of comment on how this would look. How would you respond to the criticism from the bank lobby, and what do you think is going to happen because of that?
I think what's important to remember is that financial infrastructure is evolving over time. Anytime access to core systems expands from anyone who's innovating, there's going to be a debate, especially from existing participants in the system. I think that's normal, and I say it's generally pretty healthy. And the model that we've always operated under is actually quite conservative from just even a banking perspective, right? We're not taking credit risk. We take only collateral risk. So institutions like ours operate on a full reserve framework, which means deposits are not being used for lending or maturity transformation in the traditional sense. So the risk exposure is our risk management system. That structure reduces certain categories of risk that exist in what I consider fractional reserve banking. And so the master account for us is very straightforward. It just allows us to hold balances at the Federal Reserve and settle transactions in US dollars. That shouldn't be something that is up for debate. It exists within the framework. And if we are moving crypto to fiat, fiat to fiat, as we do worldwide, then it allows us to then enable USD settlement and overnight balances, as I mentioned before. It's nothing more and it's nothing less. So there's nothing really to push back on. We already do this every day on behalf of our customers in crypto assets. What it ultimately does is just improve efficiency and risk management because settlement occurs at the central bank money rather than through multiple layers of intermediaries, as I mentioned. The place where people think about pushing back is that the term skinny bank can sometimes obscure what is actually happening structurally. And so the model here of fully reserved versus a credit interacting with the payment system is what they might be getting after. And then we've been having a lot of conversations about, interest reserves and rewards and stablecoin rewards. They might be sort of conflating everything together. But for us, this is very specific to what we think we need to be able to do in order to serve our clients all over the world, right? 15 million plus. And as you know, the Federal Reserve System is also evolving as new types of financial institutions emerge. We are one of them. We're pretty large and we continue to grow. And so the important thing is that access comes with that regulatory oversight and supervision and very clear guardrails, which is what we have.
So you don't think it's going to lead to the collapse of the U.S. financial system?
I definitely don't think it will lead to the collapse of the financial system.
Do you think that your colleagues in the crypto industry should also be given these charters?
The goal here isn't to disrupt the banking system. It's to make the plumbing of the financial system safer and more efficient. So if our colleagues and compatriots in the ecosystem are doing the same thing and they're going to go through the same regulatory oversight, we would be advocates of that as well because we are all partners at the same time.
So I think that leads to the next big story happening at Kraken that was just announced earlier this week, which was a partnership with the Nasdaq to offer tokenized stocks, which I think is the biggest buzzword in crypto right now, maybe besides stablecoins. Obviously, we've seen the New York Stock Exchange move into this. This seems like this is going to be the competitive alternate route going through the Nasdaq. So can you talk about what this launch was or what you're moving toward?
Does tokenization compete with traditional exchanges? Is this a new route to trade stocks outside of traditional markets? I think this is what typically people will think about. And then why is the Nasdaq even involved if crypto is supposed to disrupt? I would take a step back and I would frame this as not an alternate route to traditional markets. It's really an extension of market infrastructure that already exists. That's one. Two, Nasdaq built one of the most trusted and efficient market infrastructures in the world. We're all used to it. They came in the 70s to portray this out. It's very similar to what you're seeing in crypto, just a different generation. And what we're doing together with them is connecting that regulated market infrastructure with programmable digital asset infrastructure. Okay, well, what does that mean? So what does tokenization allow you to do? Well, it allows equities to exist in that digital instrument that can move across all of these blockchain networks that's interoperable while still preserving the underlying rights and regulatory protections of a traditional market, which is what a lot of people have been discussing. So the goal is not to bypass the exchange or market rules. It's allow those assets to operate in more continuous and globally accessible financial systems. So today, the systems are pretty siloed, right? Like you've got the US markets, Canadian markets, European markets, Asian markets, et cetera, et cetera. So most equities are effectively, how I think about it, static instruments. And so they trade during market hours. is settled through multiple intermediaries, and they sit inside brokerage systems where the utility is extremely limited. When you've got tokenization, it upgrades that infrastructure so that equities can interact with financial apps in DeFi if you want to, trade in a more continuous market environment, lending against it, borrowing against it, and then move more efficiently as collateral across different financial systems as well. That's a lot of what we've been focused on. We launched our platform xStocks late last year. It's been one of our fastest growing products. It's also the number one tokenized securities products in the world so far. And so this is just an added layer on top of it. And Nasdaq, I think, was excited to do it. And we spent a lot of time educating them on how this works. This is actually very synonymous to how they started, because as markets evolved, exchanges had adapted to technology, right? And so electronic trading replaced floor trading. And Nasdaq was at the forefront there. So now you think about programmable infrastructure, it's expanding what markets can do. I commend Nasdaq in taking a pretty large leadership role here, where most people have been really afraid of it.
Well, by alternate, I meant that their biggest competitor, the New York Stock Exchange, is also pursuing a similar product plan. They just announced a massive investment, or their parent company did, ICE, I should say, announced a massive investment in OKX, a different crypto exchange. They're also working with Zero, a blockchain, for helping with financial infrastructure. Why is what your partnership looks like going to win over what the New York Stock Exchange is doing?
We built what I call a non-walled garden approach. So we wanted to make sure that you had a permissionless token that could be traded anywhere, on any self-custodial, non-custodial wallet. And I think anyone who's doing anything in this ecosystem, you want to see like where those assets sit. So we work with Bybit, we work with BNB, we work with Tron, we work with Chainlink, we work with Solana Dexes. All of these decentralized exchanges, DeFi protocols, are also adopting and using xStocks. Part of what Nasdaq is doing here, and I think it's a positive signal, like everyone sort of fits here, is that they're thinking about what their traditional markets look like, and giving issuers rights to be able to get access to broader distribution. So I think generally it's a positive signal that any major exchange like NYSE, and obviously Nasdaq in this case, are investing in anything that's blockchain infrastructure. Markets are evolving over time. Exchanges have to adopt to these new technologies, get new market access, new participants. With the xStocks ecosystem very specifically, as I mentioned, like building that infrastructure layer that allows all of these tokens and these equities to exist across all regulated markets in DeFi as well, and across multiple blockchain networks, I think that's a primary focus for us. And so traditional exchanges are primarily focused on what I call trading venue and price discovery. For us, xStocks is interoperable, it's accessible, and then it allows multiple people to be able to interact with that equity, or that tokenized equity, with any new financial infrastructure, such as digital wallets, on-chain applications, programmable settlement systems, while preserving all the rights that you see for an issuer. So you've got two sides of the market. It's really not about competing, because I think you're going to have multiple people being interoperable with these assets. It's more about how you swap them and what you can use them for.
Last question. How soon until every time an everyday person trades a share of Tesla will it be on tokenized rails?
The best case scenario is the same speed at which you saw USDC and USDT proliferate. Where did stablecoins proliferate first? Well, it was in international markets. You had it in Latin America, Africa, and Asia as the starting point. If you look at where most of the demand comes from for Tesla, Nvidia, McDonald's, S&P 500, it's coming from these markets where they invested in safe assets like stablecoins in their mind. That's a hedge against inflation alongside BTC, ETH. I think what you see with infrastructure is that changes tend to happen gradually than all at once. So we've been talking about real world assets and trading these equities for almost 15 years. You're just starting to see these things tick now. And look, we've done like 25 billion of cum volume. That's nothing compared to what you see in the traditional markets. And so right now we're at what I call the infrastructure phase, where exchanges, regulators, and financial institutions are building these foundations for tokenized assets or real world assets. And so once that infrastructure is in place, which is what we're betting on, then the user experience evolves very quickly, which is what you're already starting to see too, mostly in international markets. So it's a new participant and a new set of constituents wanting to participate in US equities markets. So I think over the next few years, you'll start to see more of these tokenized assets move from what I call niche use cases into more mainstream financial workflows. But what I think is more important is you won't know that you're using tokenized infrastructure assets. You are just getting access to the asset. And so you can still do continuous trading 24/7. It's programmable collateral, so you can move it across global access to capital markets and different products, and not just US equities, but Chinese or Indian or European. And I think that's really the key piece here, is that broader access, multiple products, multiple assets that you have the ability to be able to hold and trade and use for whatever forward mobility looks like.
Arjun, thank you so much for joining us today.
Thanks for having me.
Clearly some big developments there. What struck you most in your interview with Arjun?
Yeah, well, just breaking it down. First, the access to the Fed master account is huge. I mean, this is why a lot of crypto companies have been applying for these trust charters with the Office of the Comptroller of the Currency. Obviously, Kraken went through a different route through Wyoming. This limited purpose access to a Fed master account, which basically will give them immediate access to Fed payment rails and possibly open the window to all these other really crucial Fed products, is huge, not only for what it enables for the exchange, as Arjun broke down, but also the reality that we now know under the Trump administration, which is it seems like many more crypto companies will be getting this access. We've seen a lot of consternation about this, especially from the bank lobby. The Bank Policy Institute was upset that the Fed is already giving out pilots, at least, of these skinny accounts without having the traditional public notice period. But we are certainly entering a new era of finance for the United States.
Yeah, I think this is a good thing. And I think this is the way to go about it. Do a trial period, make this skinny account, go innovate, have a sandbox. Because I think the old regime of just, the Gensler era, like stamp it all out, didn't work. So I think this is kind of the way forward. It'll be interesting to see what happens in 5 years. Is this going to be, our crypto company is going to be a full part of the ecosystem? Will they have access to the Fed discount window, where you can get the best interest rates and emergency loans and stuff like that? That'll be really interesting to see. One final note, I have to say I was a bit surprised that Kraken's the one who's out front on this. I mean, a very innovative company. I've known them for years, and I've got full respect for Kraken. But you never think of them as kind of the biggest. I know, there was Caitlin Long's thing has been trying for years to get that master account. You'd almost expect from maybe Coinbase or something to get it. But Kraken seems to be really doing a lot. They're kind of going to start pushing their other brand of Payward, which is the parent company, because they've got these different trading platforms. And as they go towards the IPO, they seem to have this real kind of big suite of services. I'm going to be really curious to see that S1, see their books, how much money they're making. But I think too, with this, these two developments, we only talked about the one of them, the master account. I think the partnership with Nasdaq is huge too. They clearly seem to have their finger in a lot of pies. I've been skeptical about a lot of the crypto IPOs. No offense, Gemini, but what's the point of that? What's the other one that I'm down on?
BitGo?
BitGo? No, I could see BitGo. Bullish. Some of these just seem very, going public because, you're just kind of being opportunistic and riding the wave of it. But Kraken's taking its time to do it. I know they had some sort of C-suite shuffle, but I think this is really, kind of one of the big league companies to watch if they ever make it out, because I think in the bigger picture, I mean, you're the venture guy, but is that IPO window closing, or do you think they still have a few months?
I mean, it's been interesting because we've seen so many IPOs not really succeed over the past year and a half. I think every time you sort of see the window opening a bit, something bad happens, either tariff drama or some new war or the SaaS apocalypse with AI. It seems like there's never really a good opening for it. But like you said, I think of the companies to potentially go public, Kraken certainly is the furthest along. And I think this partnership with Nasdaq will certainly further its claims that it should be a public company. We've seen a lot of developments with tokenized stocks recently, including the New York Stock Exchange and its parent company, ICE, making some moves, including a giant investment into OKX, which Ben wrote about last week. But in many ways, I think Kraken is even further along. They have their xStocks platform, which is already doing tokenized stocks. And I think Arjun made a really coherent claim to some immediate advantage of this, namely people outside the US having more readily available access to stocks. And he also said, maybe charitably, that it's not really a question of NASDAQ versus the New York Stock Exchange. He thinks there'll be many different venues where this will rise, sort of similar to the fact that both of them exist right now. I did try to press him on, what the real advantage of Kraken is over the other ones. And I think the response was they are just further along right now. And I think that does seem true. The bigger question for them is whether the demand is also there.
Yeah, and I mean, Kraken's got the crypto reputation. They've always struck me sort of as a crypto person's like crypto exchange. Going more broadly to what you're saying about the tokenization, it's still taking shape, but I would argue that is the meta narrative for this year. 2 years ago, it was ETFs. Last year, it was stablecoins. But I think this year, the tokenization of equities, there's no stock in this train. The more, far-fetched ones, maybe real estate, maybe all the rest of it. We've seen this movie before, but this is the closest to fruition I've ever seen it before. Anyways, on that note, thanks everyone for listening. As always, we're going to have a whole bunch more on tokenization in future episodes, I'm sure. We'll go with Visa, MasterCard, the whole 9 yards. But that's a wrap for today. I'm Jeff John Roberts.
And I'm Leo Schwartz. See you next time.